Much of the stock market narrative revolves around what stock to buy. On the other hand, the topic of when to sell a stock receives little attention, and that's understandable. For buying a stock is the easier part, but deciding when to sell is always tricky for two reasons. First, if you sell a good stock and it becomes a multi-bagger, that's the perfect recipe for a lifetime of regret. Second, if you don't sell a bad stock, it can go on to destroy wealth. Now, if you are an active stock investor, you would have also faced this dilemma. Chances are you would have done the opposite of what was right. That is, sold off a good stock and continue to hold a bad one. So how do you decide when to sell a stock? We will discuss that in today's video. Hello and welcome to ET Money's YouTube channel. On this channel, we have discussed how to pick stocks of various types extensively. We have a complete playlist around that. While we'll continue to make more videos on picking stocks, knowing when to sell a stock is as important as knowing what to buy. So let's talk about that today. At appropriate points, I will also discuss when not to sell a stock. Now, if you have loss-making stocks in your portfolio and are trying to figure out what to do with them, this video will be super helpful to you. You can analyze such stocks using the pointers mentioned in this video. Okay, so let's begin with the first case, when you should consider selling the stock. A deterioration in business is the first reason you should sell the stock. Now, business deterioration can take many forms. It could be that the company is losing its market share, or its core product or service has developed a problem that can't be solved for the foreseeable future, or the management has made a strategic mistake, or the company's founders may have been found siphoning off funds, or a new competitor has disrupted the market. It could be any reason that has direct bearing on the business. For instance, consider Reliance Communications. The company was one of India's earliest beneficiaries of the telecom revolution, but it made a strategic mistake of betting on CDMA technology instead of GSM technology, because of which its market share was eroded. When the company realized its mistake, it tried to pivot to GSM technology quickly. To attract consumers, it slashed the prices. Soon, the competition in the sector intensified and the company's market share loss accelerated. Its debt button also started to go up. Then entered Reliance Jio with its free data offers. This virtually sealed the fate of Reliance Communication. The company stopped its operations in 2017 and was sent to NCLT for debt recovery. It is still fighting legal battles to settle its dues. Its debt currently stands at over 40,000 crore. Now, figuring out Reliance Communication was going downhill was no rocket science. There were ample evidence. It was easily available to anyone who just followed the news. So the earlier one sold out, the better. Interestingly, the company's stock is still traded. Even if one just followed the stock price, it would have indicated that something was terribly wrong with the company. But there is one caveat before you sell out a stock due to business troubles. Do ensure that the setback will have a lasting impact on the business. Don't sell out just because of a temporary problem or a repairable crisis. It's normal for a business to go through ups and downs. Now, when a good business goes through a lean phase and its stock is battered, that's often a good time to buy the stock, not sell it. As the situation improves, the stock price tends to bounce back, thus rewarding those who identified the opportunity during the distress. Now, this brings us to the second reason to sell the stock. The second reason for selling a stock is related to deterioration in financial performance. For instance, a serial fall in revenues or profits, a decrease in margins, a rise in debt, a weakening of cash flows, and so on. For instance, on your screen are the companies in BSE 500 group of stocks whose revenues have contracted year on year for the last 3 years. A notable case here is MMTC. Its sales have collapsed from 30,000 crore to just 5 crore amid reports of the government closing it. Let's now take a look at the BSE 500 companies whose profits have fallen year on year for the last 3 years. Two notable cases are Sri Renuka Sugars, whose losses have risen from 117 crores in 2021 to 627 crore in 2024, and India Cements, which has slid into losses from profit. Interestingly, if a company reverses its poor financial performance trend, it could also be on the turnaround path. If you would like to know more about picking turnaround stocks, do watch our video on that topic. The link is in the description. Now, many investors base their selling decisions on the stock price. They think they should sell the stock to cut their losses if the stock is falling. Now, the stock price is not the right metric on which you base your selling decisions. Don't sell a stock just because it's falling. Instead, dig deeper to find out the reason for the drop. If the stock is falling amid a broader market or sectoral correction, you need not sell. If the stock is falling due to a change in sentiment or a temporary problem, again, you need not sell. Rather, you can think of buying more. When good businesses undergo a correction, that's the time to accumulate more of their stocks. But if the stock is falling due to serious problem with the business, you may consider selling it. Alright, let's move on to the next case now. An important component of stock research is building an investment hypothesis. An investment hypothesis is a reason or a set of reasons you think a stock will do well in the future. Maybe the company is venturing into new markets, or it has a slew of new product launches, or it's turning around, or it's going to be acquired, or the sector itself is witnessing an upcycle, or the stock is undervalued, etc. Whatever it is, if the investment hypothesis or the specific reason you bought the stock is no longer valid, you can think of selling the stock. For instance, consider Interglobe Aviation. Amid the turmoil in the aviation space, including the shuttering of Go First and Jet Airways, the company not only stood tall but also turned profitable in FY24. But in Q2 FY25, after 7 straight quarters of profits, it again reported a loss. Now, if you bought the stock based on the hypothesis that the company is turning around, this loss challenges your hypothesis. You should consider digging deeper to find out what resulted in the loss and whether the reason is temporary or if it can continue to impact the company. If it's more structural, you may want to sell the stock. You may want to wait for one more quarter, and if the company again turns a loss, you may want to sell it. Or you may cut your stake in the company to reduce the risk. Of course, we are not asking you to do any of these. These are just examples. The point I'm trying to make is that when your investment hypothesis is challenged, you need to take action. Now, this brings us to the next reason to sell the stock. The next reason to sell a stock is that it has become overvalued based on valuation metric or even multiple metrics. Now, there are a variety of valuation metrics: price to earnings or PE, price to book or PB, PE to earnings growth or PEG, price to cash flow, enterprise value to EBITDA, market cap to sales, and so on. Now, based on which metric you like or which is most relevant, you can evaluate the stock. For instance, on your screen are stocks whose PE to 5-year median PE, PB to 5-year median PB, and PEG ratios are all above 2. Now, these stocks are in the overheated territory, and if you hold any of them, you should be cautious. While you may not want to sell out the stock, you can surely reduce your stake in them or rebalance your portfolio by selling part of them. But there is one reason when a higher valuation is justified: if a stock is undergoing a re-rating. Now, stock re-rating happens when the stock starts to command a higher valuation due to fundamental change in the underlying business. For instance, consider Reliance Industries. The stock underwent a re-rating after the launch of Jio Telecom service around 2016. Until about 2018, the stock traded at a PE of less than 16. After that, its valuation re-rating happened and it has traded in the PE band of 23 to 37 since 2020. So, do check if there has been a development that has re-rated the stock before you rush to sell it. Also, don't set price-related targets for selling. Many investors tend to sell out when the gains reach a particular level, say 25% or 50% or 100%. What matters is valuation and not the actual price itself. So track valuations, not the price. Now, don't see stock gains as some kind of lottery that needs to be encashed. The real magic happens when you hold on to a stock for a long term and it goes on to become a multi-bagger. Okay, now let's talk about the next case when you should sell a stock. When you bought the stock, you found it attractive due to a variety of reasons. Maybe you liked the business or the growth or the valuations were cheap. It could be anything, but things don't remain the same. It's normal that you find something better as times change, or maybe something better within the same space. Now, in that case, you can decide to sell a less promising existing stock and buy a new one. For instance, post its merger with HDFC Bank's net interest margin or NIM has taken a hit. falling from 3.92 to 3.41 year on year as of March 2024. Its peer ICICI Bank has been able to maintain its NIM at 3.79%, which is also higher than HDFC Bank's current NIM. Given this, an investor may choose to replace HDFC Bank with ICICI Bank in the portfolio. Again, we are not telling you to do this. This is just an example. Research thoroughly before replacing a stock in your portfolio with a new one. Now, in the name of better opportunity, many investors churn their portfolios a lot. That's unproductive too. If you constantly change the stock in your portfolio, you don't give them sufficient chance to work, and this will seriously impact wealth creation. So when you replace an existing stock with a so-called better one, do ensure that you are not doing so because you have got bored with an existing stock or have found something more glitzy and flashy. The same logic applies when the stock doesn't seem to be going anywhere and other stocks and the broader market are racing. Don't give it into the urge of selling out if there is nothing wrong with the business. Sooner or later, the stock will trace its fundamentals. Let's now discuss the next reason for selling the stock, which is rebalancing. Rebalancing or restoring the asset allocation is generally talked about in context of mutual funds, but stock investors should also rebalance their portfolios. If you have a more elaborate asset allocation wherein you have stocks, mutual funds, debt, gold, etc., you can rebalance the portfolio to restore it from time to time. This will require you to sell some stocks from the stocks portfolio. For instance, if your target allocation is 35% equity funds, 35% stocks, 20% debt and 10% gold, and due to the bull run it has become 40% stocks, 40% equity funds, 12% debt and 8% gold, then you can sell 5% stocks, 5% equity funds and buy 8% debt and 2% gold to restore it. Now another way to do this is to reduce the concentration of wealth in particular stocks. If a couple of stocks in your portfolio have given tremendous returns and now command a sizable share of the portfolio, you may want to move some money to the other stocks that haven't run up. But doing this will clash with the idea of riding your winners, right? If you rebalance your portfolio, how do you get multi-bagger returns from a single stock? Now both the views, rebalancing your portfolio and riding your winners, have merit. Which one you choose would depend on you. If you have great conviction in your stocks, you may want to ride your winners. But if you become uncomfortable with concentration of wealth in a few stocks, feel free to rebalance your stock holdings. There is no right and wrong answer here, so choose whichever suits you best. Now this brings us to the last reason why you should be selling a stock. If you realize that you shouldn't have bought a stock in the first place, you can consider selling it. For instance, you may have bought into the wrong sector or theme, or you may have not researched the stock properly, or maybe you bought a stock on a tip or because your friend was buying it too, or you may have bought just too many stocks so your portfolio now resembles an index. It could be any reason, but if you are no longer comfortable holding a stock and regret buying it, you can consider selling it. So these were 7 prominent cases when you should sell a stock. Of course, there could be more, but the point is that you should base your selling decisions on careful thought and not impulsive behavior. But one important aspect still remains. What should you do if you are also making a loss on the stock you want to sell? Should you wait? Should you sell out anyway? Should you buy more and then later? Let's discuss this in the concluding section of this video. So what should you do with the loss-making stocks in your portfolio that you know you should sell? While there are no one-size-fits-all approach to this, one thing is for certain: don't buy more. In other words, if you find yourself in a hole, stop digging. You can choose to wait if the stock has good chances of recovering, or the fall appears to be reversible, or the fall is primarily due to a market-wide correction. You should sell if the company's prospects appear to be bleaker. That way, you can limit wealth destruction. Now, many investors mistakenly believe that if they just wait, things will eventually be fine. That's not a guarantee. Things can actually get worse too. Selling a poor stock has another hidden advantage. Doing so will allow you to redeploy the capital in a better stock, which hopefully can recoup your lost capital and earn you returns too. So decide wisely. Now you can use these points discussed in the video to decide whether you should wait or sell out immediately. And with this, we have come to the end of this video. I hope you found this video useful. And if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.